Hi, it's Blake Davenport with the Davenport Group in Long and Foster, bringing you this week's real estate tip of the week. This week we're going to be talking about private mortgage insurance, and we're going to be talking about what it is and what you need to know. So let's jump in. So private mortgage insurance is comes up when you get a loan and you're putting less than 20% down. The lender requires that you get private mortgage insurance because they say or they think that you are not as safe of a borrower as someone who's putting 20% down. So they make you get this insurance in case you foreclose on the property. Typically, it's about a 0.5% to a full percent of the loan every price every year. So say you get a $400,000 loan, you're going to be paying between an extra $2,000 to $4,000 every year. So it adds up. That's $200 to $300 a month. It just depends on the lender. They all vary. But what you really need to know about PMI, it's something that you can avoid, and it's something that people know about, but they think that they have to pay it. I would recommend that you not pay it, and I'll run through the scenarios in which it would be good to have it and not, because there's a lot of different options you can do. So say you get an interest rate of 4%, and you have to have a monthly PMI payment. And actually, I just want to throw in there, one thing to know is that your PMI, it only stays until 20%, and then you can ask for it to be removed. Once you hit 22%, it will automatically get removed from the loan and your monthly payment. But so when you have PMI, say, as I was saying before, 4%, you have the option of 4% with PMI, or you can get lenders paid mortgage insurance, which you'll have a slightly higher rate, but you won't have private mortgage insurance. So maybe your rate is 4.25 with no PMI. So your monthly payment actually might be lower than the 4% with private mortgage insurance. The only situation where it would be better to have that private mortgage insurance if you plan on owning the house for a longer period of time, and that's where you kind of have to determine your break-even point. But for most people's situations, especially first-time home buyers, they don't plan on owning the home for very long, so it would be better to take a slightly higher rate and get lender-paid private mortgage insurance. You also, another way of doing it is you can keep that low rate of 4%, but then buy down or pay the mortgage insurance up front at closing. So say maybe you make a payment of $5,000 at closing, that pays all the private mortgage insurance costs, so you have that low percentage point, but then you pay the closing cost to offset it. They also have, certain lenders can finance that into the loan, so instead of a $400,000 loan, say it's a $405,000 loan, so your monthly payment goes up slightly, but you still get that low interest rate. So the reason why I bring this up, and it's a good talking point, is just you have lots of different options, and that's why when you're getting a loan, you need to explore all these different options. But generally, I typically recommend that you not get private mortgage insurance because the interest rates are low right now. Even a slightly higher rate is better in the long run and better for most people's situations. But you just have to do the math. But if you'd like to learn more about private mortgage insurance and dive deeper into what I was talking about today, click the link below to the blog post on our website. Thank you very much. Bye-bye.